Hi, welcome to Christensen Wealth Management. I'm Michael Christensen. This is part 2 of my weekly stock market update for the week of Friday, May 3rd, 2019. Thanks for watching. I'd like to jump in and talk a little bit about the current overvalued stock market. Quickly, for those of you who have not seen my chart of John Hussman's margin adjusted price to earnings ratio, this is, in my opinion, the most relevant indicator of the valuation of the U.S. stock market. Let's take a quick look at that chart. Here's the chart of Hussman's margin adjusted price to earnings ratio, and over here on the left side you can see 1928, which is the prior all-time record high valuation using this particular metric. And you can see as of March 21st, 2019, the current S&P 500 is at all-time record high stock market valuations. So that is a cautionary tale, or I should say that is just a simple warning for people who are thinking that the bull market is back. This is an extreme condition, and I would just wait for things to cool off, and it might be quite a long cooling off period. So using this particular chart, I would keep your powder dry, or as I like to say, keep your hay in the barn and wait for better times to plow your money into the U.S. stock market. Now that that is out of the way and you get the point that valuations are extreme, euphoria is off the charts, I'd like to also say that the amount of I should say investors are ignoring volatility more than they've ever done in history. When I say that, it just means that complacency is at an all-time record low based on the Volatility Index. The Volatility Index measures when investors are buying protection from stock market volatility, or in other cases, buying downside protection for stock market volatility. And right now that is at all-time record lows. Let's go ahead and take a look at that chart. This is the chart of the VIX futures and options net speculative positioning, showing where investors are parking their money when it comes to investing in volatility. This chart goes back to 2004 over here, and you can see that the volatility index was pretty low leading up to about 2012, and now it's getting bigger and bigger and bigger as the Federal Reserve, coincidentally, is printing and printing more money. So as of right now, April 2019, you can see that we're currently record short on VIX futures, which means that investors are putting most of their money, as far as VIX goes, in the direction that the volatility index will go lower, meaning stocks will probably go higher, volatility index will go lower. Now what that means in plain English is that when everybody is on one side of the boat regarding VIX and they all think it's going lower, well, typically what happens is a major explosion in the volatility index. Let's take a look at the last time VIX was driven down into the basement to about the 12 level where it is right now, and how the S&P 500 reacted. Let's take a look. This is a 2-year chart of the S&P 500 stock index in black down here near the bottom, and the volatility index in blue. And what we have here is in January of 2018, right here, we hit basically all-time record low volatility index valuations, and as volatility index skyrocketed by 270%, the S&P 500 dropped 10%. And then over here, the volatility index dropped all the way back down into August to about the 12 level, and then again 2 more times in September and the first week of October. Now the first week of October, it was around 12, I would guess, right here, and it went up about 235% on the volatility index, and as a result, the S&P 500 declined by 20%. Well, as you can see over here, right now the volatility index is sitting just about the same level as it was in June, July, August, and September and October 2018. And once again, the stock market, as represented by the S&P 500, is sitting at the exact same levels as it was in January of 2018 and September and October 2018. And we will probably, based on what I see, have a volatility explosion again, which will likely impact the stock market. Okay, let's take a quick look at the S&P 500 chart, which is in a rising bearish pattern and likely to break lower, especially because this week on Tuesday and Wednesday, we have another Federal Reserve meeting with a press release at 2 o'clock Eastern on Wednesday and a press conference at 2:30 Eastern on Wednesday as well. That should create some volatility in the markets as they announce their plans for interest rates and economic growth and all the other stuff that they have to go over. But let's take a look at that S&P 500 because I think it is down to the wire. And the Dow Jones Industrial Average has already failed, and I'll show that to you right now. Let's take a look. You are looking at a chart of the S&P 500 that goes back to the 1st of March, and you can see based on these red converging lines, which in the technical world of investing, we call that a rising bearish wedge, because bearish means potential trouble for the stock market, or existing trouble, that is, for the stock market, and bullish is a good thing for the stock market. Rising prices, everything is wonderful, but right now this particular pattern, which goes back 2 months, is converging, and we're just about to the end of it, coming into this final few days of April. So this is a rising bearish wedge, and typically what you have is a breakdown in price. The price of the S&P should break to the downside, and when it does, we shall see. I expect there would probably be a 7 to 8% drop in the stock market based on what is normal for this level of overvalued and overly enthusiastic stock market environment. But we'll just take it one day at a time. But right now, this is coming to an end, and conveniently, in the next few days, we have a Federal Reserve meeting, which could be the catalyst for sending this S&P 500 stock index lower. So be careful right now when it comes to U.S. stocks because of overvaluation and this rising wedge pattern. You will see on this next chart of the Dow Jones Industrial Average that its rising wedge has already broken. Let's take a look. Here is the chart of the Dow Jones Industrial Average since the 1st of March, and it was also in a rising wedge pattern, which in fact broke back here on, what day was that? It broke on April 25th, so was that Thursday or Friday last week? But yeah, we broke it cleanly with force, with conviction, and we're just rallying a little bit up here to be positive for the day on Monday the 29th. But the trend is broken, and I would expect some more downside for the Dow Jones Industrial Average because there have been some very negative earnings from some of the Dow Jones components. But right now the Dow is broken, and I would just use caution as well when looking at the Dow and the S&P. And let's take a quick look at the Nasdaq 100. The Nasdaq 100 is also in a rising wedge pattern, which should resolve lower at some point here because it is more overvalued than it's been in about, I think, since 2009. So I will show you that chart here in a second. But right now, this wedge is still intact. The Dow Jones Industrial Average appears to be the first one to break. I would guess that sometime this week, the S&P 500 and the Nasdaq will be the next ones to fail and start to fall lower. So we'll just see where we go this week of May 3rd. Before I go, I want to show you that chart of the Nasdaq 100 valuation right here. I said this chart was going to be the Nasdaq 100, but in fact it is the S&P 500 Information Technology Sector Index. And I got them confused because the Nasdaq 100 is heavily weighted with primarily information technology stocks. So they're somewhat interchangeable, though not the same. I would say that whichever way technology goes tends to be the direction of the Nasdaq 100. Regardless, in this chart that goes back to late 2007, you can see the S&P 500 Information Technology Sector Stock Index in light green and the S&P 500 Index in blue. And because of this post-Christmas rally right here, from there up all the way up to here, in the Technology Sector Index, the current valuation of the price to earnings ratio, which is a probably the most common valuation metric of valuation, you can see that the PE ratio of technology stocks is all the way back to where it was here on January 1st, 2008, right before the wheels flew off the bus and the stock market basically dropped about 50%. And you can see that this index went from 19.47 right here, January 1st, 2008, all the way down to about 10. So it was cut in half, along with the S&P 500, which was just about the same, but the information technology stocks definitely got cut in half by just looking at this chart. 19.47 down to 10 right over here. Now, in the last chart right here is the S&P 500 Information Technology valuation level. On this chart is showing that the valuations are back to mid-2008. So either way you want to slice and dice this chart, technology stocks are at 10-year, or I should say over 10-year high valuations, which should give you some concern. Okay, that wraps up this week's charts and this week's video. Please subscribe to this YouTube channel by clicking the subscribe button and clicking the little bell next to that subscribe button. If you're on Facebook or LinkedIn or some other social media platform, then like or follow Christensen Wealth Management while you're there. And in summary, I'll just say that valuations are off the chart, euphoric, concerning. And if you have investments that are not being advised by someone you trust, please give me a call and I'd be happy to speak with you, meet with you, or a combination of both. I'd be happy to buy a cup of coffee and get together if you are located somewhere where I am. Well, have a great day, and remember that getting back to even is not an investment strategy. That's why I make these videos, because I'm trying to tell you that 10-year high valuations should be taken seriously. I've been through 2 stock market crashes, and I don't want you and anyone else to go through another one without some risk management strategies. Well, give me a call. You can find my contact information at the end of this video or in the summary description or on my website at christensenwealth.com. Have a great week. Thanks again for watching. Bye-bye.